In this video, I'm going to walk you through every single ICT PD array step by step with clear examples so you'll finally know where smart money is really operating. But before we get into the advanced stuff, let's make sure we're crystal clear on the basics. What exactly is a PD array, and how does the PD array metric guide the price? Stick with me because by the end of this breakdown, you'll see the market through a completely different lens. So go ahead and like this video and subscribe and turn on the notification button to get notified when we upload a new video. Let's get into it.
So in the ICT concept, PD stands for premium and discount. To understand this, take any price range. Say a bullish move from a swing low to a swing high. This full range is your bullish leg. Now, if we use a Gann box or a Fibonacci retracement to mark out the range, the 50% line marks the equilibrium of that range. Above this midpoint lies the premium zone, and in a bullish market, we mainly look for selling opportunities there. Below the midpoint is the discount zone, and that's where we look for buys. So a PD array is simply this concept of premium and discount within a range. Now, the PD array metric refers to how ICT tools and levels arrange themselves across those premium and discount zones. These zones highlight where to hunt for trades, sells above equilibrium, buys below it, and they guide directional bias. Price often seeks out these PD arrays before making its next move.
Now, we will go through each and every PD array, but first, let's start with the rejection blocks. So, what is a rejection block? Imagine we have a support or resistance area, maybe even a supply or demand zone, and price reacts aggressively with large wicks. When two consecutive candles print big wicks like that, it signals strong rejection. The area from the wick's high down to the body of those candles forms the rejection block. Price often revisits these blocks and reacts again. Why? Because inside the wick and even at the candle body, liquidity still sits. Some traders place stops above the body instead of the wick, and spreads can trigger stops too. The 50% level of a rejection block is often the most important point where price reacts sharply. On higher time frames, a rejection block can even align with a lower time frame order block, which explains why sometimes they act perfectly. But a warning, rejection blocks are tricky. They're not always reliable, especially for beginners. Sometimes price instead sweeps above and targets the high. Other times, a rejection block forms directly off a fair value gap, making it more valid. You will see the price return to the block, respect around 50% and then reject, but not every setup will play out. Treat rejection blocks as a useful tool, not a silver bullet. Now, the next PD array will be the breaker block. A breaker block is essentially a failed order block. When an order block gets disrespected, it flips its role. For instance, a bullish order block that fails becomes a bearish breaker block and vice versa. Think of it like support turning into resistance when broken, or demand flipping into supply. Breaker blocks are powerful because they often confirm a market structure shift. If you see bias change and an order block fails, that breaker block becomes a key level. Price frequently returns to it before moving in the new direction, giving you both confirmation and precision. Now here's an example. Let's say that the price forms a bullish order block, but later the price closes below it. That invalidates the bullish block and flips it into a bearish breaker block. Price often comes back to retest the breaker before heading lower. Breaker blocks combine failed levels with structure breaks, which gives traders an edge. Liquidity, as a PD array, is the core driver of the market. It's the fuel that powers price. In PD terms, highs and lows are a fundamental PD array. Picture a resistance line on your chart. Most traders assume price will respect this level in reverse, but what's really above that resistance? We have clusters of stop orders waiting to be taken. Price often pushes through, sweeps that liquidity, and then reverses. Traders mistake this for a false breakout, but ICT shows it's a liquidity grab. Liquidity exists at swing points, equal highs and equal lows, and even along trend lines. For example, here we have two highs at the same level that are relatively equal highs and are usually taken out later. So by focusing on liquidity, you can build an entire trading plan, timing entries, setting targets, and finding bias just from highs and lows. Let's say we zoom into this chart. You can see that each time the price sweeps liquidity above a prior high, it often reverses, trapping traders who expected the resistance to hold. Again, when the price dips below a previous low, it often rallies back into the price range. Even equal lows are frequently swept before expansion higher to the opposite side. This repeating behavior shows liquidity is intentional. The highs and lows are not barriers, but magnets for price. One of the most popular PD arrays is the fair value gap, often called an imbalance. It is a 3-candle pattern that shows rapid buying or selling. If the wick of the first candle doesn't overlap the wick of the third candle, the space between them forms the gap. In a bullish scenario, this gap signals inefficient buying pressure, and the price often returns to fill it before continuing higher. In a bearish scenario, it signals selling imbalance. These gaps represent inefficiency, orders left unfilled during the sharp move, and filling the gap restores balance. So you can identify them by looking for strong displacement and then checking for 3 consecutive candles. If the first candle's high doesn't overlap the third candle's low, that's a bullish fair value gap. Not all gaps are equally strong. High probability gaps form with significant displacement and often alongside order blocks. Fair value gaps can invert too. When a bullish gap is violated, it often flips into a bearish inverse fair value gap, and vice versa. So context matters.
Now, the order blocks, which are another PD array, are a cornerstone of ICT. An order block represents a shift in delivery or a change of direction. When price is trending up and then suddenly shifts down aggressively, the last bullish candle before that bearish move becomes a bearish order block. On the other hand, when the price is trending down and then shifts up strongly, the last bearish candle becomes a bullish order block. These blocks often serve as key zones where price returns before continuing its new direction. High probability order blocks often form with displacements or fair value gaps, adding strength to the setup. For example, if price trends lower and then switches bullish with strong displacement, the last bearish candle before the move marks a bullish order block. Price often revisits it before pushing higher. Traders often refine entries by requiring a fair value gap alongside the order block, but even alone, order blocks give strong insights. You'll notice how often price reacts from these zones. Order blocks can form the backbone of a trading strategy when combined with context and confirmations.
Now let's discuss one of the confusing PD arrays, the mitigation blocks. Mitigation blocks look similar to breaker blocks, but have a key difference. Now, here's the thing. Instead of price sweeping liquidity and making a higher high, price fails to break the high, creating a failure swing. That failure marks the mitigation block, which becomes the level price respects afterward. You'll often see the price tap these zones multiple times before finally expanding. The mitigation blocks often form because of SMT divergences or failed continuation attempts, making them useful PD arrays to watch. They act as corrective or healing zones where market makers mitigate the excess created by previous aggressive moves before the next expansion.
Finally, the volume imbalances are simple yet powerful PD arrays. Unlike the fair value gaps, 3 candles and wicks, volume imbalance focuses on 2 candles and their bodies. Normally, the close of one candle equals the open of the next, but when there's a gap between the closing price of one and the opening price of the next, that's a volume imbalance. Price often gravitates back to these imbalances because they act as magnets. You'll notice volume imbalances frequently on indices and weekly charts, where price fills the imbalance before resuming the trend. These levels provide surprisingly precise trade opportunities and are especially useful for traders who want clean zones with clear entries and targets. So there you have it, all the ICT PD arrays. Each one of these PD arrays explains a different way price interacts with liquidity, inefficiency, and shifts in direction. Mastering them step by step gives you a deeper edge in reading the market and positioning with smart money.
I've also created other in-depth videos where I break down advanced ICT concepts and smart money trading strategies step by step. If you're serious about leveling up your trading skills, I highly recommend checking them out. Each video is packed with practical explanations, chart examples, and strategies you can actually apply in the market. Trust me, it will definitely be worth your time.
I hope you enjoyed this breakdown on the different PD arrays there's. Please don't forget to like, share, and subscribe. And let us know in the comments what trading concepts you'd like us to cover in the next video.
Thanks for being here.
Join our Telegram channel for weekly expert-curated trade signals. And for premium subscribers, our VIP signal channel offers higher accuracy and more frequent trade opportunities. Don't settle for average trades. Join a community that consistently wins. Click on the link in the description to start capitalizing on the market like a pro.
Have a drink.